Hey everyone, welcome back to the channel, where we dive deep into financial trends and strategies that impact your pocketbook. Today, we're tackling a big topic that's on everyone's mind: high interest rates. We're breaking down the why, the how, and what this means for all of us, especially if you're invested in the stock market, planning to buy a home, or just trying to make the most out of your savings. So let's get into it. Alright, so let's set the stage. At the beginning of this year, there was a hopeful buzz that the Federal Reserve might start lowering interest rates. Why does that matter? Lower interest rates can make loans cheaper, potentially boost stock prices, and generally make it easier for money to flow through the economy. However, this optimistic scenario is crumbling as we speak, and I'm here to show you why keeping a close eye on these developments is crucial. Now, the main villain in our story here is inflation. Yes, the monster that eats away at the value of money. Despite hopes from the Fed that inflation rates would cool down, allowing them to cut interest rates, the opposite has happened. And inflation is not just sticking around. It's getting worse. The inflation rates for the first quarter of this year, January, February, and March, have been alarming. We kicked off with a 3.1% rate in January, climbed to 3.2% in February, and in March it peaked at 3.5%. Remember, the Federal Reserve's target is 2%. So we are way off the mark here. So what's going on? Jerome Powell, the chair of the Federal Reserve, made some comments that really underline the current economic sentiments, and he isn't exactly brimming with confidence. The data is stubbornly pointing towards persistent inflation, and that means interest rates are likely to remain high to counteract that inflation. Powell's words are a candid admission that the Fed's initial plan to reduce rates might have to be shelved as they navigate these turbulent economic waters. Now, why should this matter to you? Well, high interest rates affect nearly every aspect of the economy. Let's start with the housing market. If you were planning to buy a home, higher rates mean higher mortgage costs, which can significantly add to the overall price you pay for a new home. It also cools down buying activity, which can stabilize or even drop house prices in some markets. And then there's the stock market. Investors generally dislike high interest rates because they make safer assets like bonds more attractive compared to riskier assets like stocks. Higher rates also increase borrowing costs for companies, squeezing their profits and, by extension, their stock prices. So, if you're holding stocks or planning to buy in, strap in for what could be a bumpy ride. Now, considering all this, what's the Federal Reserve's plan? Initially, they had projected 3 interest rate cuts this year. But given the reacceleration of inflation, those cuts are increasingly unlikely. We won't have the full picture until June 12th, when the Fed releases its updated projections. But from what Powell said, and from the data we have, any hopes for rate cuts soon seem dim. Next, let's talk about the implications of these continuing high rates. For one, it means that the cost of borrowing remains high. This affects everything from personal loans and credit card rates to business loans. It can stifle business expansion and consumer spending, which are both engines of economic growth. Also, we should consider the global perspective. The US dollar tends to strengthen when US interest rates are high, affecting international trade dynamics. A stronger dollar can make US exports more expensive and less attractive on the global market, which can hurt US businesses looking to sell abroad. So now, shifting gears a bit, let's discuss the job market. This is a slightly more complex angle. Generally, a strong job market would signal a healthy economy, which could typically withstand higher rates. However, even this silver lining has its clouds. The job market has been robust, with significant monthly job additions, like the 303,000 jobs added in just 1 month, which is incredible. But this strength also suggests that the economy might be overheating, which again points to sustained high inflation. And then, this brings us to what we can expect in the upcoming Federal Reserve meetings. The meeting on May 1st is just around the corner, and as per the CME FedWatch tool, the likelihood of a rate cut then has plummeted to 0%. Yes, 0. Looking ahead to the June 12th meeting, the chances of a rate cut have dramatically decreased from 55% to just 19%. The trends are clear. Rate cuts are off the table for now, and the focus is on managing inflation. Let's also consider the voices from other key figures in the Federal Reserve. For instance, John Williams, president of the New York Fed, noted that the monetary policy is well positioned as it stands, showing no urgency to shift gears. Loretta Mester of the Cleveland Fed echoed this sentiment, emphasizing the need for more data before any decisions are made. And Raphael Bostic from the Atlanta Fed pointed out the high levels of inflation as a significant concern, advocating patience. These insights from various Fed officials give us a clearer picture of the central bank's current stance: cautious, watchful, and not ready to make any sudden moves in terms of rate cuts. So what should you do in light of all this? First, if you're an investor, brace for continued volatility and consider diversifying your portfolio to mitigate risks associated with high interest rates. If you're looking to buy a home, prepare for higher mortgage rates and perhaps a more competitive market if prices adjust downward. And as always, keep an eye on your personal finances. Budget wisely and consider locking in rates for any loans before they potentially rise further. I hope this helps you understand the broader economic context and prepares you for what's coming. Now, I'd love to hear your thoughts. Are you adjusting your financial strategies based on these projections? Drop your comments below and let's discuss. Please hit that like button, subscribe if you haven't already, and share this video with friends who might find it helpful. Your support means the world to us and helps keep this channel going. Thanks for watching, stay informed, and take care until next time.